Welcome to another episode of Newcastle Unlocked. I'm your host, Brent Sinclair, and I'm joined by Matt Shaw, Head of Valuations, and Dan Barry, Head of Industrial. And we're here to take stock of the year that has been for 2024 and take a little bit of a peek into what the boys think is going to happen in 2025. So thanks for joining us, gents.
Thanks,
Brent.
So this is our last podcast for the year, and we actually start how we finish how we started. We kicked off this podcast idea at the beginning of the year, and what a year it's been. I think we'll run through a few of the highlights and the tribulations, but I think I have to say the market's been quite resilient, all things considered. You know, at the beginning of the year, we're always optimistic, but I do think that there's been genuine opportunity throughout the year. We're seeing plenty of demand coming through. Great to see cranes in the sky. Like, you know, at the beginning of the year, I'm talking to a few, clients and developers, and there was a bit of concern that, not a lot of projects are going to get out the ground with construction costs and and all the other headwinds that we're facing. But here we are. We've got multiple projects, not even just in the CBD, but up at Charlestown as well, which are kicking on, and a few more in the pipeline as well. So that's really positive to see. And look, we've got interest rates for industrial stock, 5.5% to 6.5%. Office stock, 6.75% up to probably 8%, depending on the sector. And we can drill down into the subsectors. But overall, I think it's been quite resilient, all things considered. And pretty positive. How have you guys found it? What's something that you guys have seen throughout the year?
Yeah, I guess from an industrial perspective, Brent, it's there's been a few things that have been key indicators for myself. Obviously, rents have been on the rise, first and foremost, which is good to see. We have had an abundance of cash buyers looking to deploy their capital, particularly investment stock, that sort of thing. They're still chasing and now still paying tight yields. And then more of a strategy piece, we've seen a lot of larger companies, particularly local, national, that are looking to consolidate multiple facilities into one. So whether that means purchasing multiple lots of land or something in the future strategically that way. So it's been good activity.
Oh, you, Matty?
Agree. Yeah, I think what I've seen, just to add to the industrial market, is Dan mentioned that you got some discerning sort of cash buyers there that are willing to deploy capital now and spend. And I think a lot of it, we stand back and go, oh, it looks like a great result for that shed or whatever that's sold. But these assets are still selling at a significant, discount to replacement costs. So I think that in that respect, there's certainly buying opportunities, and it's certainly more, potentially more favourable for a tenant to go to an existing building because, to get a new build out of the ground, it's going to cost them a lot of money in terms of rent. So I think that's the biggest thing I've seen is just that, there's where the sales are occurring, it's still at a significant discount to replacement costs.
Yeah, I think that's the big theme for investors and buyers, even as we push into the new year, that you're looking at opportunities that are well and truly below that replacement cost. We'll get into rental reversion and all of those items that are sort of at the forefront of decisions for investors at the moment as we try and tackle some of these feasibility issues with new projects. But getting into it, we do our House Views report, which is really a publication of our opinion based on evidence, but of our opinion at the coalface of where rates are sitting, where yields are sitting across both office and industrial markets. And we caught up this week, and it was interesting to hear some of the back and forth and how we do it. We get our sort of heads of department and team members to go through it. But it was interesting to hear some of the takes, especially around the industrial market. I suppose in office land, there hasn't been a lot of transactions at the upper end of the range. There's been a couple, which we'll get into, but industrial, Dan, what were some of the key takeaways from our catch up in preparing this new House Views report?
Yeah, so the first thing, as I mentioned earlier, is rental renewals. So we're seeing some key renewals in the vicinity of 170 to 220 a metre, and also some new leases in that. So your prime locations, your Cardiff, your Beresfield, Mayfield West, those sort of spots, they are outperforming the market. On the back of that, you're seeing new design and construct stock coming out with figures quoting into the early 200s, which is where it needs to be. Yield-wise, we're still quite tight with our yield spread that we're getting. You do have some investors that are chasing a buffer on the cost of capital. However, the cash buyers are still coming in, still paying to tight yields, and that's displayed by a recent sale in Beresfield by ourselves, and also one in Beresfield by another agency.
Yeah, right. And which estates are the best performers in your opinion, based on rents and yields?
Rental wise, I would say Cardiff is doing really well, just because it's not the new product. So there was a deal that was negotiated. It's a long-term lease, 220 odd square metre for a large building, 3,000 plus. So I think that's a really good deal negotiated in the market. Otherwise, we're seeing Mayfield West, sub 5-year-old sheds renewed around 180 a square metre, which is good to see as well. But I think the lead one at this stage is the Cardiff one.
And what about built product? Where are you seeing rates for existing stock buildings? Has that gone up? We try and keep our, looking at Beresfield we do these every half year. So Beresfield was, 2,300 to 3,000. We've got Heatherbrae, up to 2,250. Have they moved much in the last back half of this year?
For new stock, they've had to, just because of the land price and the construction inflation. So yes, there has been some rates achieved in that vicinity, and any investment stock will still be trending towards that 3,000 a metre improved number. But yes, like there has been growth on that, and it's back to that replacement cost conversation.
Yep. And vacancy, have you seen much where's the needle moving? Is it any estate gone sort of up in vacancy, or is it all trending down?
It's all trending down, really. I'd say across the board would be operating in industrial at sub 5%. And I think it's safe to assume that a lot of the parties, investors, sophisticated and whatnot, are looking at the industrial market as undervalued totally.
Yep. What about you, Matty? What are you seeing out there? We said you're always the brains behind this report, mate, but you're seeing it not only from what's happening in our office, but what's happening out there in the market with your clients' valuation.
Yeah. Look, I guess when we sit down and do these meetings and go through this, it's really valuable information for us as valuers. The big key for me, Dan just touched on, was the vacancy rate. Like that, basically we're all at sub 5% now across the whole of the market, which is going to continue to put pressure on rents. On the fact that there's limited stock available, and the fact that it's also cost, you need to achieve a higher rent to get a new build out of the ground. Yeah. So I think there's the two key things. The other key one, I guess, I picked up on, there's a recent transaction up at Rutherford for a large tract of industrial land, which is a big pipeline of, Rutherford's future industrial supply, bought by a local developer, sort of north of 40 million. So I think that's, shows some confidence in the market that there's developers out there, despite all the challenges with construction costs and interest rates, still willing to land bank land because they can see that the outlook for industrial, and even as far out as say Rutherford, is pretty optimistic. So that was a key point for me.
And look, we touched on it, there haven't been a lot of large transactions in the office space. Yields have probably pushed up a little bit. Generally speaking, it's we speak about it broadly, but if you're looking at some of the transactions that have occurred, probably more in the B grade space, and we are still seeing quite sharp yields in that B grade space. Again, it's possibly reflecting the potential value add opportunities, whether there's some vacancy, under rented, or again, it's still that piece buying below replacement cost. That's just becoming more and more of a conversation piece with buyers as we not only are promoting properties to sell, but also just smart investing. If you're out there traditionally a developer looking to add value through through the development process, you can look at buying existing stock across all sectors and get that uptick. And we'll get into the development sort of equation at the moment a little bit later. But I think that not a lot of movement. I think in rents. Incentives are still elevated, just reflecting a little bit of a softer market. But there have been a few more deals at the end of the back half of this year, and it's a lot of rental renewals. There are a lot of tenants renewing, and the incentives being paid on renewals is far less than out there if you're trying to attract a new tenant. But overall, look, there hasn't been a lot of movement in the commercial space from when we probably caught up, halfway through the year for the house views report. Moving on, I want to talk about buying opportunities, for the investors, the value add investors, the developers out there that are trying to work out where in the market are there opportunities. And, what I've seen personally, there's been quite a lot coming across my desk, especially in the development site space. There's been a lot of sites, great sites, have got DA approvals, but for whatever reason, they're not proceeding with them. And I think that there's in that side of thing, in that space, there's a lot of opportunities, and probably a little bit more compromise depending on the asset for buyers to come in and buy. Probably planning for the next cycle. Where are you guys seeing opportunities out there, and where are you seeing a bit of price displacement for buyers out there across all sectors?
Well, if you talk about the CBD, there's a couple of recent transactions that you're involved with both of them. I think the buyers for that, or your discerning and your sort of more sophisticated developers are seeing that construction costs are starting to stabilise. They're still high, but they're not going increasing at the rate they were over the last couple of years. And then in an anticipation of rate cuts next year. You combine those two sort of factors together, a rate cut and stabilised costs, or stabilised construction costs, and projects are starting to become a little bit more feasible again. So I think that's what I sort of see at the moment, is that there is a bit of a disconnect on price still between what vendors are expecting and what the developers or buyers are willing to pay. But I think that gap will close a little bit, particularly if they do cut rates into 2025.
Yep. All right, you, Dan, what are you seeing?
Yeah, I think it's safe to assume that any site that needs to be settled on within a 42-day period is probably not the flavour at the moment. We're finding with the industrial land, if we can delay terms, we can maintain prices.
Yep.
So, which I think just gives people an opportunity to either get a DA lodged if the land's registered, and potentially start marketing on the vendor's time, which I think has been well received and favoured. So I think that's probably providing a little bit of a cushioning effect for that, as to why we can maintain some values there.
Yep. And I think that trend to buying existing stock below replacement values, a great opportunity. Probably the opportunity out there for buyers is if it's vacant or there's not income coming in, or there's some motivation from the vendors, obviously, to buy well, but we're still seeing plenty of opportunity out there, and deals are still getting done, which is great to see. Shifting to the office market, we mentioned there's been limited transactions in our market, probably the last 2 years, I'd say, post-COVID, especially at the upper end of the range. Probably we're struggling to sort of get a grasp on where yields are actually sitting based on transactions. It's probably making your job a bit trickier, Matt.
Well, it has for the last couple of years.
And there's probably a broader spread in the lower value commercial office transactions in terms of yield, reflecting potentially the value add, development upside, possibly even that rental reversion in time. But probably the two transactions that stood out this year was one at Honeysuckle, and the one that we'll probably talk about as well is the transaction that we did at 6 Newcommon Street. So we had a circa 2,000 square metre tenanted building. It sits right at the end of Newcommon Street, overlooking the harbour, sweeping view. So great position. We ran a campaign, transacted when it was fully let, likes of Whitehaven Coal and a few other decent tenant, Chandler McLeod and Honeysuckle Health. So it was B-grade building, 2,000 square metres. We ran a campaign, got tremendous participation, 100 inquiries, 11 offers, and the end yield was about 6.5%. Now, if you listen to the commentary on the office market, it sort of seems counterintuitive, but it was a great position there. It's a great property. It's got a lot of it's uninterrupted views right up through to the lighthouse, and that's probably got a value opportunity in the future for some sort of residential conversion, possibly 5-10 years down the track. But a great sale out there in the market. But as this shows that 100 inquiries, 11 offers, if it's the right property out there, there's no shortage of buyers. Yeah.
Oh, look, I think at the upper end of the office market, if we talk about the other transaction being 26 and 28 Honeysuckle, bit of a thinner buyer pool for an asset of 40 plus million, but that sold earlier in the year for 43.3, bought by a fund manager Corval out of Sydney. That asset's got a significant amount of vacancy, and it needed some capital expenditure spent on the building as well. But I think, touching on your point earlier, Brent, in terms of value add opportunities, I think there's as much value add opportunity in that in terms of total return than taking all the development risk on a development project and looking at it going, actively asset manage a building like that, try and actively lease up the vacant space, renew existing leases that are coming up for expiry, and undertake a capex program within reason that's diligently managed, and you can make a good return out of an asset like that. And I think that's where the Corval guys out of Sydney, that'll be their motivation. Buy at a price that's at a significant discount to replacement costs. Like it's sold for $4,500 a square metre of NLA, right? Like it'd be maybe not quite double, but it'd be close to double to replace that. So I think that'll be a good opportunity for them in time, assuming that the office fundamentals get better. And with people returning to work, I think they will. It'll be a matter of time how long that takes. But, with the government the state government sort of edict from Chris Minns to get all the government workers back into the office, I think that's just going to, stimulate the market here in town also.
And you touched on that. There is a mandate, especially from a government level and from the big corporates, to get workers back into the office, and it's probably more prevalent in Sydney and capital city markets. But we're noticing it here in Newcastle. The car parks are getting full. The coffee shops are busier. So there's definitely a trend. It's hybrid work is here to stay, but there's definitely a trend back there. So for the likes of those buyers that sort of want to get in and diligently work on the vacancy, I think they're going to get well rewarded. And even in commercial, we're noticing, we're in office, we're noticing that landlords are getting a lot more creative with tackling vacancy and getting tenants in there. Like spec fit outs have become commonplace, and they're getting rewarded as well. They're getting results. We're seeing it out there in the market, mostly in the smaller 150 to 300 square metre range, but it's just they're putting in a generic fit out. When I say generic fit out, something that's going to be universally appealing to multiple office users going forward. So they're investing in it, taking out some of that upfront capital, and that's probably one of the biggest barriers if you're an office user that wants to grow. Like our business is growing, we want to move, we want to we don't want to spend money on a fit out. So if someone's willing to go and spec fit out something, and they're willing to take on that long-term view, I think it's definitely working. But at the moment, while it's soft, landlords are needing to do what they have to do to get deals done, really, and planning long-term. So you talk about like the likes of Corval doing it.
And I think just adding to that, it's just given where the cost of construction, including fit outs, are at, you can probably really only afford to do that up to, say, 300 square metres.
Yep.
So the key takeout out of that is that landlords are willing to sort of take the punt to try and attract tenants, and they're starting to do it. So it'd be very difficult to try and do that for a 1,000 square metre floor plate, but at least that there's some of these smaller sort of suites and stuff are starting to get filled up, and that combined with just a general recovery should be pretty optimistic for the office market over the next couple of years.
Yeah. Switching away from office into industrial, investments still have been quite strong. There's been a couple of transactions, even the last few weeks, that have supported that, strength in the market. So how are you finding things? You had an auction at Cameron Park for Cameron Park asset. How are you finding things out there? What are the conversations you're having with buyers? Who are the buyers, and what sort of yields are you hitting?
Yeah, sure. So for those listening at home, last week we took to market 114 Stenhouse Drive, Cameron Park. It was a Bunnings trade facility, roughly 2 years left to run on the lease. So the buyer pool, overall it was a great campaign. It yielded over 35 bids at the auction, and it sold ultimately for a 5.8% yield. Myself and my co-agent Michael Boom, we've had quite a number of personal congratulations on that, but honestly it was what we were expecting to get. When you start breaking it down and looking at it as a comparison compared to some other sales or land selling. Like you've got, for example, Mayfield West, you've got industrial land trading on usable areas north of $900 a square metre. So a 5.8% yield here reflected on site area, $902 a metre.
Yep.
So for that $2, you get a 3,000 metre building and Bunnings for 2 years and nearly 800,000 in rent. I don't think, apart from sophisticated investors, I don't think the market is looking at property like this. And this comes back to what you guys both touched on earlier. You're talking below replacement costs purchasing. So that reflected roughly 2,400 a square metre over the building area, which is about in line with market. And especially if the building's built around that 40% site coverage, it is something that I think buyers need to be looking at the rate per metre over site.
Yep.
And look, you look at that sale, right? So it was 6.66 mil. Yep. So to go and get that block of land and build that same building, you're probably in
And fill it.
and yeah, well, even if you want to buy it as an owner occupier, right? You're going to be in it for 10 mil, or close to. So, you know, that just points back to that whole sort of, you know, disconnect between where assets are trading at and how much of a discount it is to replacement cost. And what I noticed also out of that sale, that campaign Dan and Michael ran, was it was largely cash buyers that were participating, and certainly in the room on the day. And it says to me that they're willing to start and throw their money out there, not needing debt finance, and they're discerning buyers. The guys that participated, from my understanding, were all pretty sophisticated and they like the asset. And I think, touching on Dan's point, it's a really strong result, but it's also where we expected. And, it look, in some respects, it looks cheap potentially because land is $1,000 a square metre at Steel River. So it's encouraging for the market generally.
And it was spirited bidding on the day too. I can't, was it 30 bids?
Yeah, 35.
35 bids, multiple parties. Like it was, right the way through down, right down to $5,000 bids at the end. So it was competitive, and that just shows you the strength of that industrial market as it rolls on. There's been a lot of talk about rental reversion in the industrial space, and that leads into some of these sharp yields being paid and these sophisticated buyers going hard on some of these assets.
Yes.
Are you seeing much movement in rents for existing stock to support the land values that they're being achieved on land releases? And how long do you think it's going to take for this correction to happen?
Yeah, sure. So to answer your first question there, if land rates are in the vicinity of 600 a metre, we need rents north of 200 to make things viable for developers. So, for example, Beresfield, where you have a new release of industrial land coming on at Black Hill, there will be rents quoted out there in that new estate there north of 200. I'm guessing somewhere in the vicinity of 220. But then over the road, you have existing stock there that's anywhere from 10 to 20 years old that probably has current passing rentals of 140 to 170 a metre. So it's almost like we're operating a two-tier market at the moment. So most of the leases historically negotiated in Newcastle are thereabouts of 5 years. So assuming, if we look back, this rental reversion discussion probably started 2 years ago. So over the next 2 to 3 years, I expect it to sort itself out with the renewals market review at the next market review opportunity for investors to basically bring their rents up in line with what these newer results are being achieved. Now, I think the most important thing for an investor in this scenario is make sure your asset manager is across the concept of rental reversion and how it works, and make sure that they're working closely with their sales and leasing team to ensure that everything
is captured, and
absolutely,
you're not wrecking the value. Look, we were only talking yesterday about a couple of examples of where that opportunity or that value add has been limited by, I don't want to say poorly written leases, but mechanisms in the lease that have affected and taken out that value upside. We've got two examples. One was a capped market review for an industrial asset that when we took it to market, it in the vicinity of about 15 million, a bit more. The fact that there was a capped market review on the options limited the participation, well, limited the price expectation. If that was uncapped, it would have definitely increased the value. But also, we've talked about another long lease that you were talking to me about. What, a 10-year lease?
Yep.
What?
10-year lease, below 3% fixed reviews and no market review opportunity. I think, traditionally, 3 years ago, a 10-year lease would have been fantastic.
You would have been happy with a 10-year lease, So I can see how it happens. You take a 10-year lease, you think it's going to set and forget, but at the same time, if you're not careful,
And that's where property can become illiquid, basically.
Yeah.
It's
If you need to put in those, especially in the market, it is, the uncapped market reviews in midterm. If they're long leases, midterm uncapped market reviews, just to make sure that you capture that uplift as it progresses. If you're saying it's only going to be sort of 2 to 4 years where you're going to see that correction, there's going to be a dramatic increase in rents potentially.
That's right.
And that's just going to put more pressure on it. So you really got to protect your value of your asset by including it.
And look, to add to that, like I talked to the valuation colleagues in Sydney, it's the same fundamentals with the industrial market there. You are talking, bigger institutional size stock, but the investors, whether they're institutional or wealthy privates, are still looking at it the same way. If they got something there that's, locked away for 10 years with, minimal fixed increases or, conservative fixed increases versus an opportunity to come up for expiry in 12 months, that's more attractive because you can capture the upside.
Yep.
So, it's not common just to our market. I think it's a broader thing for industrial generally.
Yeah, and I think it's 100 basis points. That reversion, because like you saw some larger industrial stock transact at the start of the year that had no rental reversion opportunity. It was at full market, 10-year leases trading at 6.75% thereabouts. So, I think it's worth about 100 basis points to the market.
Yep.
Yeah, well, the yields are telling a story, aren't they? And keeping with industrial, land supply. Can you talk us through where the land supply is coming from in our region and where we headed over the next few years?
Yeah, sure. So, I mean, for the masses, the large amounts of supply: Heatherbrae, Tomago, Black Hill, Loxford, which is Kurri, Morisset, Warnervale, and Rutherford.
Yep. And what, interestingly, Kurri, when's that looking at coming on? That's a great looking project. When's that looking at coming on?
2026.
Yeah.
So it's it will be a very good project. Obviously, you've got Snowy Hydro in there at the moment, which is I don't know if anyone's been out there, but there's hundreds and hundreds of employees working out there. So it's really vibrant as a little area. So it'll go well.
Sure. And when are some of these likely to drop? Are they a lot of them coming on in that 2026, right? Or are they obviously Heatherbrae's already available?
So we've got 10 hectares registered at Heatherbrae back into this week.
Yep.
Tomago there'd be another 10 hectares there, plus there's probably supply of another 20 that could be another 2 years away. Mayfield West, there's lots there, and there's obviously the connectivity of the road behind Total Tools there is going through. Civil works are underway there. Morisset's, you've got registered land there ready to go, in the vicinity of 20 hectares. Warnervale, there has been, so obviously the estate there has been registered for some time. What we're seeing there, which is probably subduing land values a little bit, is profit-taking activities. So people that have bought historically off the plan a couple of years ago, instead of taking the risk of the development, they're just trading out of the land. So we did see sales as high as 600 a metre there, but now, from what I understand, asking prices have come back into that early to mid-fives.
Great. Well, I think the infrastructure spend too is going to help most of those estates you just mentioned. Like with the M1 extension, that's going to certainly help Beresfield, going to help Heatherbrae, even to the degree, Morisset back this way a little bit. I think just that sort of, general sort of broad infrastructure spend across the whole region is going to just help all markets, but certainly industrial.
Yeah, well, even I think from a growth point of view, like you look at Heatherbrae, when that road goes through, it's 3 minutes from Black Hill. Black Hill's probably trading at $100 a metre premium.
On land.
Yeah, on land at the moment. So I think Heatherbrae is going to be...
There'll be catch-up opportunities.
And for Tomago as well.
Yeah. Well, that's probably a good segue into looking at some of the wins that we're seeing in our region, whether or not it's, built product infrastructure programs. we talk about that M1 extension from through to Raymond Terrace is just coming on leaps and bounds.
It's been a long time coming, but it's great. Like you drive up there now and you see it all happening. You're like, wow, this is really going to happen now.
And for locals, just avoiding that whole Hexham Bridge interchange, it's just going to be great for the region, great for business, unlocking a lot more. Reducing that travel time is going to be great. Running through a few other projects, and Matt or Dan, feel free to jump in. But One Apartments taking shape, GWH's project. It's looking great. A couple of cranes up there, and that's all kicking along. Dome has kicked off their towers. 352 apartments coming out the ground. Again, cranes in the sky. So that's a great vote of confidence there. Great spot right next to the train station. In residential land out at Minmi and Cameron Park, you're looking at 858 lots at Minmi. I'm not quite sure how many out at Cameron Park, but Cameron Park, it's a good news story. They've got that Harrigan's looks great. I haven't been out there yet, but it gets busy out there.
Yeah,
and you've got that whole precinct coming to life. The two projects at Charlestown, which are well and truly in an advanced stage of construction, I think they've topped out the GWH's project there at Macquarie Tower, 53 apartments up, plus multiple levels of commercial. GPV's got the hospital project and medical centre. That'll be completed, first quarter of next year, $80 million spend. We touched on the M1 extension. And probably the exciting thing in the paper has been the talk of the link of fast rail between Newcastle and Sydney. I know this comes up a lot. It's been flogged to death, but they're spending a little bit of money, so we can actually get some of these out of the ground. But I think that there's a lot happening, and that's sort of circling back to what we said at the start of the year. I think there's a lot happening in our region, despite some of the headwinds that showing a lot of confidence. We touched on that big sale at Rutherford. Developers are getting projects out of the ground.
If you talk just on the CBD apartment projects, like we do a bit of work with GWH on it from a Val point of view, and going through and going down to their sales office and talking to the guys there, is that their buyer pool for that product now for their apartment product is much broader than what it was previously. A lot of it previously in some of their earlier projects was a lot of downsizers, but now it's a broad mix, like across from couples, young families, that sort of also 35 to 50 age bracket. It's generally a lot broader than what it was previously, and that's a function of there's a lot more, I guess, confidence in what's happening in the CBD. They like that developer's product as well, but also like it's from a first home buyer's point of view, it's potentially they're getting more comfortable in this region, at least with apartment living, versus having to go out and buy land and build a house, which with construction costs and the cost of land is pretty expensive. So that's a bit of the feedback I got, was that there was first home buyers looking at apartment product.
They chase the amenity too.
Chasing the amenity, because in some of the further out areas, the amenity's not quite there. So, certainly in town that's there, and it's appealing to the buyers. So that gives me a little bit more confidence in the market too.
Prediction time, gents, as we end the year. 2025's fast approaches. What's your predictions for next year? What are you seeing out there? What do you think is going to happen? There's talk of a rate cut. There has been for a while. It keeps getting pushed back. But what would a rate cut mean? When do you think it's going to happen? It's all speculation, of course, because who knows?
I'm not going to speculate on when it'll happen. I hope it does. But I think what I touched on earlier around development projects, with construction costs starting to level out, I think the rate cut will start and make projects more feasible, and you'll potentially see projects that were mooted to come out of the ground maybe start, and probably some activity in site sales as well, or more activity in site sales. So, that's, I guess, my sort of in broad, pretty brief prediction. But I think the interest rate cut will just generally spur more activity generally.
Yep. What about you, Dan?
Yeah, I'll put a different spin on it. I am regularly asked the question as to whether I've got buyers asking me that says, is now the right time to buy or should I wait? And I look at it in the sense, so I had a conversation with sophisticated investor last week, and he said to me, he said, why would you wait if you've got the capital ready to deploy? Because you'll miss the opportunity for your first rent review. So let's say hypothetically you bought an asset, $5 million asset at 6%. You got $3 million worth of rent. Let's say hypothetically you're in for a 3% review somewhere in your first 6 months. If we have a 25, 50 basis point cut on interest rates, and you're able to maintain a valuation at your 6%, you've picked up 150,000 in your capital value. So his words to me was, why would you wait? So I think, fundamentally, if you are to wait, you're going to be jumping into a more competitive pool. Where at the moment you're competing with less.
Well, particularly if that rental reversion opportunity is only for the next couple of years.
Yeah.
Absolutely. Look, I see that a rate cut, like what you said, is going to spur activity. We're not short of demand. We've been tracking our demand levels, number of inquiry, demand, participation in campaigns, and we're not short of offers and inquiry, but there is definitely that disconnect between the yield spread and the borrowing rate. So that's really been difficult, especially for tenanted investment stock, mainly in commercial, that's got the right rent, got market rent. It's just been difficult to get buyers and sellers into that range where they're willing to compromise and do a deal. And I think that a 50 or 25 or 50 basis point cut will really help just with transacting more of those deals, getting that compromise, also giving the market a little bit more confidence. I think that buyers have been reluctant to want to take a short to medium view that the market's going to go up given the subdued or elevated interest rates. But if you start to see a bit of a rate cut, that's just going to give them that bit of confidence that market is starting to turn, it's starting to balance out and pay a little bit more. And that's just going to allow us to have more meaningful conversation with vendors. So I do think that whilst we're still getting deals done, I think that that's really going to help spur on that activity, get more transactions flowing, and that's going to trickle down into development site sales, feasibility of projects, and have a little bit more, just more transactions happening. So plenty to be optimistic about for next year. I think we'll leave it there. Thanks very much for joining us today, gents.
No worries.
Thanks, Fred.
Thank you.
Merry Christmas to everyone. This is our last podcast for the year, but we will be back next year, and we look forward to catching up with you then.